Hello and welcome to Live Wire Markets Fund in Focus. My name is Anna Dadich. Today I'm joined by Damien Boey from Wilson Asset Management. He's going to be talking to us today about their fund, the WAM Income Maximiser. Hi Damien, thanks for joining us.
Thank you for having me.
Can you provide a brief introduction to the WAM Income Maximiser? What is it, what's in it, and who is it built for?
The WAM Income Maximiser is designed to invest in Australia's highest quality companies in such a way that we can generate a sustainably high yield for investors on a monthly basis. How do we do that? Well, in terms of what do we invest in? We invest in stocks listed on the ASX 300. Secondly, we invest in debt securities. Now, those debt securities could be government bonds, whether state government bonds, federal government bonds, we can invest in those. It can also include the bonds issued by the corporates that we invest in on the equity side. So there's a wide range of assets that go into it. In terms of who is it for, it's for anybody who wants a monthly income. It's for anybody who's after a little bit of inflation protection, because our desire is to give you a target dividend yield, a minimum dividend yield, which is sufficiently high above the RBA cash rate.
So the fund is quite new, only launched at the end of April this year. Tell me a little bit more about its genesis and the team behind it.
The genesis of it is that we are living in a world where inflation is a bit higher than normal. So we do think that people want to have an income that is suitable after inflation. The second thing is, as I mentioned before, our shareholders overwhelmingly wanted a monthly income product, so we decided to meet that need. The third thing in the background is that the so-called hybrid securities that are issued by banks, so they're essentially debt securities that the banks issue but are convertible to equity on certain triggers. They've essentially been phased out by the Prudential Regulatory Authority. So a lot of people are therefore looking for a replacement or an enhancement on that sort of product, and so we did a lot of thinking around that. Another reason why we've done this is we can see that on a longer term view, the world has gone very growthy in terms of equity, so technology stocks and things like that, things that offer you a payout in the very long term, but not necessarily in the short term. And so we decided to create a product that we think goes against that trend, so that we can offer some diversification just in case that trend were to unwind. In terms of who is in the fund, so Matt Haupt is our lead portfolio manager. We have Anna Milne, who's a deputy portfolio manager. Also, I guess we have a lot of resources that are across different funds like Leaders and Income Maximiser. We have a bigger, broader team behind the scenes to draw upon. And then there's myself operating as a portfolio strategist.
What makes WMX different from other income funds on the market today?
The thing about it is that it's the only listed investment company in Australia that invests across debt and equity. So there's a fair bit to unpack in that. The fact that it is a listed investment company structure, the listed investment company can do two things. Firstly, it has the ability to smooth the earnings to be able to convert that into a dividend. And then secondly, it has the ability to generate its own franking. It invests across debt and equity. So there are a lot of LICs that invest in equity only or credit only or debt only, but this is investing across all of them. And the beauty about this is that we're not stuck there holding stocks that some people might consider value traps. So for example, if you're a high dividend yield investor, you're typically investing in companies that are cheap, and often they are cheap for a reason, and it can take a while before they actually recover. If we're stuck holding those sorts of companies, we might be able to get you the income over a 3-year horizon, but we would be leaving behind a lot of capital or net tangible asset growth on the table. So what we've done is said, look, we want to be able to generate the higher than average income, but we want to flex the debt side of the portfolio to be able to do that, which in turn frees up the equity portfolio to pursue those opportunities for capital growth where they arise.
So you're aiming to deliver monthly income above the RBA cash rate plus 2.5%?
Yes.
So how do you plan to meet or exceed that?
Yeah, so two things. One is to understand the journey that we're on. And the second thing is to note that we are very active in the way that we manage the fund. So let me talk a bit to the journey. In the world that we are living in, it's characterised by incredibly high correlation or co-movement between government bonds and stocks. In other words, if interest rates go down, bonds rally in price. Stocks tend to go with them, led by the usual suspects, long duration, bond proxies, technology, those sorts of things. That correlation is very, very strong, and it's very, very unusual. So typically, if you're running a passive fund, which we're not, a passive fund relies on bonds and stocks not moving in sync with each other, so that one asset class might rise, another one might fall, but on average and through the cycle, you win out with the appropriate weightings. That's kind of how passive investment is designed. But when you've got the two big components, bonds and stocks, moving together, you lose that diversification benefit. You lose the ability of the fund to generate returns through offsetting components. And this is a really big deal. When you've got that sort of environment, basically you're saying, look, I think interest rates will fall to make the market go up. And the way that you would express that is through a really bullish view on the right sorts of equities as opposed to government bonds. With that in mind, we're looking at that and thinking, yes, you don't want to ignore financial bubbles. You don't want to ignore these dynamics for what they are, but you do need to think longer term about how you can get some diversification into a portfolio which doesn't actually have any. So that's kind of one thing that's really important. And you might be looking at commodities, you might be looking at particular equity styles that are not crowded, those sorts of things. The second thing that's worth noting about the macro environment is that money markets are protected. And because money markets are protected, what you're seeing in bonds and credit is an incredible amount of leverage taken out by hedge funds to play the fact that money markets are protected. As a result of that, we see some really, really strange phenomena in markets. For example, there's something called a swap spread, which essentially compares the credit risk pricing of a counterparty in the financial markets, private sector, versus the government. And what you're finding at the moment is it's negative. And the negative swap spread is telling you that actually government debt is more inconvenient or risky to hold than some forms of corporate paper, which is astounding. That we think is all a result of protected money markets and essentially a lot of leverage written on the back of that, which is in turn distorting bond pricing. So we have high bond equity correlation and we have distorted bond pricing through a lot of leverage. But the third thing is that when you have this sort of setup, and markets and money markets in particular aren't allowed to fail or to break, it's very hard to see how you're going to get tightening of financial conditions that would eventually slow growth enough to drop inflation. So that's the dilemma that we're in. That's the journey that we're in. So you could actually see in this environment, central bankers try to cut rates. That would be seen as an extremely bullish signal for risk assets, only to see inflation resurface again, which would then undermine a bit of that. So that's the journey and we need the flexibility to do that. Now, in terms of the levers that we can pull to manage that journey, we are active managers. And so the levers that we have, we can change the duration risk profile of our portfolio. So we can go longer duration, shorter duration, fixed rates versus variable or floating rates. We can do that. The second thing that we can do is we can slightly change the credit risk profile of our portfolio. So if we think it's risk on, we might take on higher yielding or a larger spread corporate credit as opposed to the really safe stuff or the government stuff. The third thing that we can do is, of course, we can make an asset allocation decision between debt and equities, and we can flip that around. And the fourth thing that we can do is within the equity portfolio, we can split it up according to different style, sector, geographical type exposures and manage risk that way. We actually think that given how crowded the investment space has become, given how strange some of the code movements have become, you will need every single one of those tools to successfully navigate the environment.
The fund is split 60% equities, 40% bonds. So why is that important and what flexibility does that give you?
We did a lot of back testing to see what is the best way in Australia to generate a sustainably high monthly income. What sort of portfolio weights do you need? And what was really interesting when we did the analysis, going back to the time that we have liquid corporate bond markets, is that an optimization will show you that there's almost no role for government bonds. Actually, if you had a portfolio of high dividend yielding equities plus corporate bonds, investment grade corporate bonds, that usually does the trick. And if you want to emphasize the importance of franked dividends, because corporate bonds don't offer you that, then actually the weighting goes towards 60% equities and 40% debt. That is our benchmark that we measure our performance against, but we are not wedded to that allocation. We can change it, and we do so quite frequently. So there's quite a lot of flexibility. We can technically max the weights between 0 and 100 on either the equity or debt portfolios, but typically what you'll see is that we'll be changing it around 10 to 15% weight around the benchmark. And as I was saying a bit earlier, even within a particular universe, whether it's debt or equities, we can cut it up in different ways to be able to generate a bit of outperformance relative to the own asset class. So our preference is to try to max out the amount of return that we can get in an individual asset class before we wholesale change the asset allocation. But to your earlier point, there are many levers that we can pull.
Okay. Can you tell me what role WMX plays in a portfolio?
Yeah, absolutely. So at the outset, I mentioned that diversification is really hard to get. What we want to be able to do is provide that longer term diversification for shareholders while providing the income. The two go hand in hand. We also want to demonstrate that actually we understand the journey that we're on. We're not ignoring market conditions for what they are. So WMX is a vehicle that's able to play the short-term continuation of recent themes, but also position against unwinds of them for the longer term. And in that way, we're generating the diversification. We also want to be able to generate superior income to the market without sacrificing growth in our net tangible assets. We're not ignoring capital growth. We don't want to be so blind to just investing in income that we would leave capital growth on the table. So WMX is a portfolio, A, designed for diversification, but B, we really want to balance the desire for monthly income after inflation with capital growth.
So where can people get more information about the fund, and how can they access the fund?
Yeah, so it is a listed investment company, so you can literally go out and buy it on the stock exchange. If you want more information about how the fund works, the different metrics that we use to judge performance, the different levers that we can pull, that's all available on the Wilson Asset Management website. And we write frequently, we do a lot of webinars and videos and things like that, so there's plenty of information.
Okay, thanks Damien for sitting down with Livewire today, and looking forward to our next chat.
Thanks very much for your time.
If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel where we release new content every week.